It's not just bringing data, but it's actually bringing meaningful data. One of my favorite quotes is it's a Simpsons quote where statistics can be used to prove anything. 60% of people know that. You also have to make sure that consistency around that data and that everyone really believes in it is an important part of the world. There's different things that, while operationally it might be better to have something that you can measure daily or you can drive in a certain way, but all we really care about is driving growth and profitability at the kind of highest level. So all of your metrics need to align to that, or you need to be able to reconcile to that in order for it to matter.
Is this thing on?
Yesterday's price is not today's price.
And welcome back to Run the Numbers, where I interview world-class CFOs, operators, and the investors who fund them on how to get the most out of your company's performance. This podcast is a playbook of sorts for ambitious people in the worlds of finance, strategy, and operations. Today, my guest is Cameron Heiser, the CFO of ZoomInfo, a publicly traded data platform for go-to-market professionals. ZoomInfo is one of the most efficient and profitable SaaS companies out there. Their P&L is a true work of art. On this episode, we cover why you should focus on quality versus reducing costs as a CFO, share repurchase programs 101, weighing the best use of a company's cash, how the CFO is responsible for translating the external economic environment to the operations of a company, the hallmarks of any great CEO-CFO relationship, and frameworks for making resource allocation bets. Cameron was responsible for taking ZoomInfo public during COVID, ringing the bell on the NASDAQ over Zoom. He's a master capital allocator and a cool hand at the wheel. I'm excited to add another public company CFO to our list, especially one from a unique and profitable data juggernaut. For all you efficiency metrics buffs out there, this is one you won't want to miss. All this and much, much more after a short word from our sponsors. As a SaaS CFO, I know firsthand how difficult it is to report on SaaS metrics. We've all seen a deal close at the end of the month, but the customer's contract doesn't actually start until the middle of the next month, creating the classic discrepancy between bookings or committed ARR and actual ARR, the real stuff. That's why I'm so pumped to be partnering with Maxio, a company trusted by thousands of SaaS companies to understand these reporting nuances. They basically built and automated the SaaS dashboard I tried to manually cobble together for 3 years. In 2022, SaaS Optics and Chargify combined to become Maxio, the only billing and financial operations platform that was purpose-built for B2B SaaS. They're helping SaaS finance teams automate billing and RevRec, manage collections and payments, and put together investor-grade reporting packages. Visit maxio.com/runthenumbers to learn how Maxio can help you supercharge financial operations in 2024. Request a demo using the Run the Numbers link and receive a 10% discount on your first year with Maxio. That's maxio.com/runthenumbers. If you're a startup founder or executive running a growing business, you know that as you scale, your systems break down and the cracks start to show. If this resonates with you, there are 3 numbers you need to know: 37,000, 25, and 1. 37,000. That's the number of businesses which have upgraded to NetSuite by Oracle. NetSuite is the #1 cloud financial system, streamlining accounting, financial management, inventory, HR, and more. 25. NetSuite turns 25 this year. That's 25 years of helping businesses do more with less, close their books in days, not weeks, and drive down costs. 1. Because your business is one of a kind, so you get a customized solution for all your KPIs in one efficient system with one source of truth, manage risk, get reliable forecasts, and improve margins. Everything you need in one place. Right now, download NetSuite's popular KPI checklist designed to give you consistently excellent performance, absolutely free at netsuite.com/metrics. Oh yeah, your boy loves metrics. That's netsuite.com/metrics to get your KPI checklist. That's netsuite.com/metrics. I really need this, guys. Please go to netsuite.com/metrics. Woo! Cameron, welcome to the Run the Numbers podcast, and thank you so much for joining me today.
Thanks for having me. That's great to be here.
So you run one of the world's most successful data businesses, and many of our listeners may be more familiar with a typical B2B SaaS operating model. I'm curious if there are any nuances that jump out to you, either on how you monetize your business or forecast it, that you could speak to.
Yeah. So certainly from a business model perspective, like data businesses are subscription businesses in a lot of cases. We do have very small amount of usage-based revenue, but it's primarily subscription. When I think about forecasting and what we do, it's largely about what does annualized revenue look like in terms of the sum of all the subscriptions, whether that's ACV or ARR, however you want to think about it. And then what are the ads, whether that's new business or upsell, what is the retention and renewal? And that's really, how do you manage those things? How do you really assess the forecastability or consistency of those things? ZoomInfo's really high ROI, and it's really obvious as soon as you see the system where you can get value as a salesperson. So I think relative to a lot of B2B like SaaS offerings, we have much shorter sales cycles, which in many ways is great. In some ways, it does make the forecasting a little more challenging just because you have quicker decisions being made. But given that that's really the product of just customers being excited about the system kind of the minute they see it, it ends up being a positive overall.
And I'm curious, do you define your customers as they have to be like past a certain threshold and spend, or is everyone who pays considered a customer?
Everyone who pays is considered a customer. Certainly when we think about the business, we do divide those customers into cohorts. So larger customers, when you're spending over, say, 100K, that's a more sizable part of our business. That's close to half of the total business. And it's a little less than 2,000 customers versus the 35,000 plus customers that we have overall. So we very much think about it in terms of those cohorts, the 100K plus, the $1 million plus kind of customer sets. But anyone who's paying us is a customer at the end of the day.
Yeah. It's great that you break it out, though, in terms of if you're above 100K and then if you're above 1 million, because it's probably a different buying habit and user behavior.
Yeah, it's definitely a different buyer habit. It's different. There's more stuff, once you get to spending more money. And certainly in reality, once you get over 100K, you're probably getting a little more scrutiny in the business. Once you get over $1 million, like a bunch of enterprises have levels where they're running reports and requiring different sign-offs. So it also means that those customers have more visibility within their within the enterprise into the spend, and frankly, they're getting more value out of it as a result.
Okay, so I've confirmed that a data business isn't all that different on the surface, at least from a revenue perspective. But what does jump off the page to me compared to other SaaS businesses, or let's say a cybersecurity business or an infrastructure business, is you are incredibly efficient. You have high gross margin, and you are one of the most efficient orgs I've looked at. And that trickles all the way down to cash flow generation. So I'm wondering if from your seat, you can speak to the difference between quality versus reducing costs. How do you square those two themes when you think about efficiency?
Part of being profitable or more profitable than your average software company is a little bit of being a data business versus being a software business. In reality, we kind of scrub the quality of our data once, and then we can kind of sell it to all sorts of different people. So that's a good thing. Although honestly, like I've also worked at software businesses that are more profitable than your average software business. And a big part of that is just the culture of the company. When I came here, I was really excited about the fact that Henry, our founder and CEO, and a large swath of the executive team were all very bought into running an efficient business, making sure that we're not just growing at all costs or being wasteful with spending. And as a result, I think the culture of ZoomInfo is one that really helps to drive more efficiency and profitability at the end of the day, which is exciting. And that is a big part of why I came in, is to really, as we continue to accelerate growth or get to scale, make sure that we're reinforcing that over time. So part of that just starts with what we sell. Not only is it data, but we're selling, a platform that can really help salespeople be more effective and efficient at their job. We have a lot of customers that tell us that they sell 20, 30% more, or they reduce their rote tasks by 20, 30, 40%. We are by far the biggest leveragers of our own platform, so the biggest users of our own platform, and that translates into having a really efficient sales team. If you think about on the inbound motion as an example, like in real time, we're enriching every lead that comes in, and we're routing that to the SDR that's most likely to close that deal, or the AE that's most likely to give the best demo, that understands that customer the best. And that obviously makes that whole team more effective and efficient. So if you look at most software businesses, their cost of sales and marketing oftentimes can be well into the 30s, 40s, 50% of revenue, maybe even higher if you're really trying to grow fast. So a world where we're able to be really effective, really drive value for our customers and kind of show them that value, and our sales and marketing expense as a percentage of revenue is in the 20s, like that translates into a much more efficient business just by itself. And that kind of push pervades throughout the organization.
If your sales and marketing is only in the 20s, you're already 10 percentage points ahead before you even get to the rest of the P&L. That's powerful.
Yeah, it's powerful. And I think that one of the things that helps drive that is, you talked about quality versus other things. When we're investing into different things, we don't just focus on like what's the cheapest thing that we can bring in. When I talk to other CFOs about our platform, as an example, there are cheaper solutions out there. There have always been cheaper kind of low quality data solutions out there. And if you think about your average B2B salesperson might have a quota of like $500,000 to $1 million. So every percentage point of improvement that you can drive is worth $5 or $10 grand. At the end of the day, on a per seat basis, like our solution is usually less than $5 grand. So that's an area where sophisticated buyers will look at it and say, yeah, I could get a cheaper solution for half the cost, or save $2 grand or something on a cheaper solution. But then I'm missing out on literally tens of thousands of dollars, and maybe in some cases $50,000 of improved sales on the other side.
It reminds me of something that Sam Walton of Walmart was super passionate about. Jeff Bezos took up this too, but they both said, hey, there's a fundamental difference between being the cheapest and being low cost. Cheapest is relative to what others are pricing at. Low cost is indicative of the overall quality that you're providing. And what you're speaking to there means a lot, because you're saying that your mission is to provide something at a cost that's reasonable and over indexes on the quality of what the customer is getting.
Yeah, totally. And that's what I think has made ZoomInfo successful, and continues to be why, particularly as you get into larger and more sophisticated clients, like no one chooses the kind of cheaper solution that's low quality as they get up into the high end. And I think that as we talk to different customers, it's helping them understand what is that benefit that you're going to get by having, even at the least sophisticated customers, of just using ZoomInfo as like a lookup tool for stuff, chasing less things down a dark alley. If you're getting bad data, your people are following up on that. They're spending time trying to figure out if that's the right person or whatever else. And those dark alleys are time wasters for a lot of people. In some cases, it's almost better to have no data than like really low quality data. But really high quality data makes all the difference in the world in terms of supporting that team, making sure that they're going forward. And Henry talks about every once in a while that one of the things that kills sales teams is frustration. Sales is a hard job, and it used to be that finding out about your customers was kind of a big part of your job, where we're able to make that a lot easier and help you focus on really prioritizing the places where you can add the most value. That like really energizes the sales team. Whereas if you're giving people lower quality data, they're going to get frustrated with that. They're going to start being quiet on the sales floor or complaining about all these things. And really what you want them to do is be out selling, being an advocate for your company, and being high energy. And that's kind of the nice little side effect of having great tools for your sales team as well.
I originally asked you, Cameron, about efficiency in your kind of cost profile, but what's jumping out to me is that your product itself, you're really selling efficiency. You're really selling signal and you're selling time. And that, in essence, is bigger than just selling data.
Yeah, and that is where we focus.
Cameron, CFOs out there would kill for your efficiency and cash generation profile. And ZoomInfo had a 40% adjusted operating income margin in 2023, and you generated more than $450 million in free cash flow. I got to ask, what's it like to have so much cash on hand? Does it help you sleep better at night, or does it also stress you out that you have so much cash, you got to find a good use for it?
It certainly helps me sleep better at night. I don't know that I've ever worked for a company where I was worried about I can't raise funding and gonna have to cut things in a huge way or whatever else. So like that would probably stress me out more than I need to. But certainly like we are super focused on what's the best use for our cash. So it does create a different dynamic. It's kind of a first world problem at the end of the day.
Yeah, it's a champagne problem, but with great power comes great responsibility, as they say in Spider-Man.
And I think for us, we believe in running an efficient business, and that also means running an efficient balance sheet and making sure that we're doing the right things. We've obviously we've been impacted by the macroeconomic changes that have happened. And I think a lot of our customers have been more impacted than others because it's a lot of software companies and technology companies. So our growth profile has changed over the last 2 years. And as a result, I think we're in a position where our stock price is really attractive, well below what we believe is the intrinsic value of our stock. And therefore, a lot of cash generation means that I can go and buy back a bunch of stock, really generate better returns for our shareholders as a result of that. And so I think that's obviously a good solution to that champagne problem. And I still have capacity if there are interesting things that come up in the world for potential acquisitions or other things that, having that flexibility to kind of do both is a great position to be in.
I'm so glad you brought that up, Cameron. So you ran a share repurchase program in 2023. Can you give the audience a bit of a share repurchase 101? So how does it mechanically work?
There are a bunch of different ways that you can repurchase shares. Ultimately, as a public company, you have different SEC kind of regulations and procedures that you need to follow. But the short answer is you can either buy them in the open market, you can run a 10b5-1 plan, which is kind of you set a plan based on different triggers and it buys back, or you can do an ASR, which effectively a bank will give you a bunch of the cash up front, not all of the cash, and then they'll go and repurchase the shares based on a certain percentage of the trading volume that's out there. We're really focused on being efficient with our repurchases and effectively being opportunistic when the share price is down a little. So we've focused on open market purchases when they're available to us, and then setting 10b5-1 plans up during our quiet periods, which is important. And I think that's been really successful for shareholders. We've bought back $400 million worth of shares. It's 22 million shares at the end of the day, over 5% of our market cap in 2023. And I think that ultimately where you think about in the long term, all businesses should be valued on free cash flow per share. Taking out 5% of the shares means that free cash flow per share going forward is going to be 5% higher. And there's continuing opportunities for us to do that. So there's mechanics around it. And then there's how you think about the strategy. For us, the strategy is really when we're trading well below intrinsic value. Right now, we're trading in the kind of teens level on a per share basis, or a teens level of kind of multiple of cash flow. That's a great opportunity for us to generate value for our shareholders going forward and really deploy that cash and return that cash to shareholders in a meaningful way.
And for those out there, and probably stating the obvious, what you're saying is you're basically deleting shares from the denominator in the equation. And by doing that, each shareholder gets more free cash flow per share as a result.
100%. Yep.
And you use the word opportunistic. How much of this at the beginning of the year you sit down with, I don't know if it would be your FP&A team or treasury team, maybe you can speak to that. Do you sit down and say, hey, Q2, let's put one of these on the books. Here's the size that we'll do of a share buyback versus how much is you wake up on Monday and say, like, we're worth way more than this. I should buy some.
Yeah, and certainly we have a lot of conversations with our treasury team and the board and other management on we have advisors that come in and help us with here's what the market looks like and how that changes. So we have a view that over time that we believe we're going to get back to a more normalized growth level, something that's like a teens-ish or maybe even over 20%, growth level. And when you kind of roll that forward and think about 3 to 5 years out, what does that sort of company look like from a valuation perspective? That's a higher multiple. And obviously we're going to be generating more cash flow as a result of that. And so that obviously indicates a higher stock price that you then just count back to today. And so there's a lot of inputs into that. And I don't think that the intrinsic value of our stock moves around all over the place. So in reality, we kind of come to an agreement as to what we think intrinsic value more or less looks like. And then we're just being opportunistic to say, look, if our intrinsic value is X and we're trading at X minus whatever, that's a good time to buy. And frankly, this public market stocks move around a lot. So if stock goes down, that makes it a little bit more attractive relative to that intrinsic value. And if stock goes up, it makes it a little bit less. So that's where we're able to lean in more when there's negativity in the market for one reason or another that we don't believe impacts our intrinsic value. And over the past month or so, we've seen the stock go up a little. So maybe we're still well below that intrinsic value, but there's a little bit less opportunity in that depending on where you are.
Cameron, when you came into ZoomInfo, did you anticipate that a lot of your day would be translating the macro into the micro as we're talking about here? You are in many ways the voice of kind of the outside world and how the economy translates into ZoomInfo.
I think that's the job of any CFO, to really kind of be the bridge between management and the business and the board and our investors. And so I think that's been my job kind of everywhere. Certainly during the course of my career, I've seen a couple times when we've had, call it macroeconomic shocks.
Couple cycles, yeah.
Yeah, that have impacted the businesses that I was working for slightly differently. It's always interesting because you have macro, which obviously impacts everyone, but different businesses have different variability to that macro. So if you think about in 2008 and 2009, I worked for a company called ES Software. We sold order management systems to hedge funds and other folks. And it was interesting because the initial problem with the financial crisis hit hedge funds really hard, right? There was a huge shutdown of hedge funds and everyone was worried about risk. So that was really tough for our business. But we, continued to invest through that. And what ended up happening is that 2008 was a really tough year, but part of our business was also based on trading volumes. And so when volatility goes up, you got a little bit of kind of improvement based on the trading volumes. And then what happened is the SEC put in a whole bunch of rules for hedge funds that they needed to manage their risk better. They needed to kind of have better reporting. They needed to have more disclosure for their investors and for the SEC. And that actually drove a huge boom of business as you came out of that into 2009 and 2010 for ES. So while it was still a tough world for a lot of companies, there are interesting little dynamics that happen across different businesses. At ZoomInfo, it's a little bit different where we're actually, and I don't know that we 100% realized this because we weren't around earlier, but a little bit more higher beta relative to the macro. And if you think about it, sales teams, when things are going well, they want to invest as much as possible into growth and continuing to get the most out of their teams. When the macro is tough and their companies are pulling back, sales is often an area that gets impacted a little bit more. So we felt a fair amount of the brunt of that. And then the other big impact is that we sold more to software and technology companies because those were our early adopters. And as a result of that, software and technology over the last 2 years has gone through a reckoning that growth at all costs is not necessarily acceptable anymore. If you're a venture-backed company, like your well of potential, additional funding has certainly dried up to some level. And so a lot of our customers were really reducing the size of their sales teams purely to get to a profitability or break-even level that they hadn't contemplated before. And so that's another angle for us. So like a lot of what we've done over the last couple of years is really thought about, okay, we have these pressures. They're worse than a bunch of other companies. How do we make sure that we're maintaining margins and cash flow? Because when you see that kind of growth change, like that's an important thing that's, not easy to manage. But then also, how do we work with our customers more so that when we start to come out of this, they're going to be excited about really driving more investment, more efficiency out of ZoomInfo. And so those dynamics are, very different than what we saw 2 years ago. And I think understanding your own business and how it's impacted by these sort of things versus just what's the overall impact is really important to being successful through these challenges.
Cameron, it sounds like by staying close to customers in harder times or bad times, you have a better chance of managing that beta. Hey, thanks for listening. We'll be right back after a word from our sponsors. CRMs are slow, hard to configure, and overly complicated. Attio changes that. Attio is a radically new type of CRM built specifically for the next generation of companies. It's flexible, easily configures to your unique data structure, and works for any go-to-market motion from self-serve to sales-led. Attio automatically enriches your contacts, syncs your emails and calendars, lets you create powerful custom reports, and quickly builds intricate Zapier-style automations. Say goodbye to one-size-fits-all CRMs and outdated user experiences. With Attio, you can focus on scaling your company to the next level. Try Attio instantly at attio.com. That's attio.com. That is attio.com. Well, you know what I always say, maintaining compliance is never complete, which is why most security and IT teams feel like they're always in audit purgatory. I'm there right now. But there is a solution, and it's easier than you think. Escape the infinite loop by using Thoropass's compliance and audit solution. Thoropass is the only solution using AI-infused technology and in-house auditors to take your team from start to stamp without leaving the platform. As a winner of multiple G2 awards, including top awards for usability and service, your team is in good hands with Thoropass. From onboarding with dedicated experts to audits from in-house auditors who know every aspect of your framework needs, you can have complete confidence in your Thoropass compliance journey. Thoropass is the only solution to offer audits for your most needed security frameworks. I'm talking HIPAA to HITRUST and SOC 2 to ISO 27001. Woo! If you need PCI, DSS, pen tests, or any other major compliance framework, Thoropass can hook you up. With Thoropass, you never need to worry again. Relax, we fix audits. Find more at thoropass.com. That's THOROPASS.com. Tell them your boy CJ sent you. They'll hook you up. Boom.
Yeah, and I think that's true. But at the end of the day, the beta can be tough if we have customers, and we do have a bunch of customers where they've literally laid off like 40 or 50% of our users. Like there's managing the beta is one thing, but it's not like you can go to those customers and just say, let's maintain your spend. Like you have to go to them and say, look, we want to make you successful. And we understand that when you're half the size you were before, you're probably spending significantly less with ZoomInfo than you were before as well.
And it's not just you. You look at net dollar retention rates across the board in software, they're probably 10 to 15% lower than they were before. Like the benchmark itself is just lower.
Yeah, 100%. And the interesting thing is when we talk to other investors or people who invest into like private companies, they will tell you in our space, so those people that are selling to like sales teams and whatever else, it's not 10 to 15 down, it's more like 30 plus down.
Wow.
And yeah, I think that's the sort of thing that you need to realize, that like different types of businesses have different types of impacts related to external factors. And so, yeah, like our particular industry is actually down much more than your average a team that sells into the like if you sell into the IT org, like those budgets are actually a little bit more protected than if you're selling into the sales teams, as an example.
That's a great call out. You have to benchmark yourself not only by what sector you're in, but also the ICP you're selling to.
Yeah, 100%. And yeah, that ends up driving the sector, but helps you understand what to focus on and what's important.
Cameron, you mentioned translating the external world into your ZoomInfo world as kind of a trait or a quality of CFOs. What qualities do you think separate the good CFOs from the great CFOs?
A great CFO at the end of the day needs to be able to operate well with their team, but also push their team a little. And so I think that's a tricky balance for a lot of people to find, but ultimately is what drives more success for the business, being able to kind of make sure that we're not just investing into stuff, but we're investing in the best way. We're not just hiring the right amount of people, but we're hiring the best people. I think that those are really important. Obviously, being able to kind of see the problem from multiple angles is like another trait that I think the best CFOs can really leverage. They see the problem from the business side, they see it from the investor side, they see it from individual employee side. I think even honestly for me, one of the things that I really kind of rely upon is that I've had a bunch of different roles in finance orgs. So even just managing your own team, understanding accounting really well and understanding the FP&A role really well and understanding the external investor side, M&A, raising money really well. Having that kind of multilinear, multidimensional perspective, I think is what really differentiates great CFOs from good CFOs, that you're able to make arguments, understand the arguments, and really come to a conclusion that's not just, here's what everyone should do, but here's what you should really do in this situation and with these groups of people. And
something you said at the beginning was pushing your team. How do you balance pushing your team and coming across as a supporter of what they're doing versus being the bad guy or the cop in the room?
Yeah, I think that's an important balance. And you think about working with other executives. I think part of it is really helping people to understand the different perspectives. It's almost being a teacher of here's why investors feel this way or that way, or here's the benchmarking of other companies that are out there, what they're doing and where we can improve, as opposed to just saying this is too expensive or we're not getting the right outcome. Helping people with understanding the thought process behind where you're coming from is probably the biggest piece of that. And then that's really kind of building those relationships where you're advocating for their point of view. You just might be advocating for it in a different way and helping them to see that ultimately as they're going through.
You brought up using benchmarks as a reference point or a context point. One of my favorite sayings is, "In God we trust, all others must bring data."
That's always a good thought process. Unfortunately, it's not just bringing data, but it's actually bringing meaningful data. One of my favorite quotes is, it's a Simpsons quote where statistics can be used to prove anything. 60% of people know that. You also have to make sure that consistency around that data and that everyone really believes in it is an important part of the world.
How do you manage financial data, operational data at ZoomInfo? Do you have a data and analytics team? Does that roll up to something under you just so there's clean data lineage? Because that's something I always try to figure out at my own company. How can we get past the point of people bringing different sets of data to a meeting? Because at that point, you've lost everybody. The meeting's over at that point. Nothing's going to come of it. How do you manage that?
You lose a lot. We actually have a team of folks within the IT team. It actually helps if they sit close to all of the systems that are really focused on data clarity, making sure we're all using the same sets of data. Realistically, as you get bigger and bigger, it's harder and harder because there's just so many different things. I actually think the thing that we struggle with is realistically, all the data comes from the same place. We've gotten pretty good at that. But we have like tons of metrics. And there's a metric to measure this. There's a metric to measure this if you're adjusting for, whatever. There's a metric that's like, well, you have something that's gross versus net, and you have all these adjustments. And so part of that is really just like making sure that that lexicon of here's what all these things mean. And in a lot of cases, it's operational. Yeah, you're not going to make all the adjustments that the finance team makes in order to make it kind of match revenue or match expenses. And so being really clear with people about what a particular metric means is super important. And then, ultimately it's making sure we're all on the same page that like you can have a metric that measures something slightly differently, but what's important is X. And so at the end of the day for us, what's important is, there's a net retention metric that is what we're going to use. There's a revenue metric that is what we're going to use. There's different things that, while operationally it might be better to like have something that you can measure daily or you can drive in a certain way. But all we really care about is like driving growth and profitability at the kind of highest level. So all of your metrics need to align to that, or you need to be able to reconcile to that in order for it to matter.
Are the metrics that you report to the street the same ones that you wake up every morning and say, this is the number one or North Star metric I have to look at just to get a grip on my business operationally? Or is that really just, are those metrics really the output of everything that's going on?
Those are the metrics that I wake up every day and like think about, that Henry wakes up every day and thinks about. But certainly individuals, they have kind of parts of those metrics that they're focused on. Because at the end of the day, like being successful is not about just like magically fixing one thing. It's about working hard and putting a lot of little successes together in order to drive big success. And so to move the needle in a company, we're close to $1.3 billion of revenue and 3,500 people across more than 35,000 customers. Like moving the needle is more about getting everyone to do a bunch of little things to like drive success. And even the big things that we're rolling out, even like Copilot, there are thousands of people behind that all doing a little part to make it really successful. And that's where you need to focus.
You mentioned Henry. I've listened to a couple podcasts with him. He's an energetic, passionate, hard-charging guy. What would you say are the hallmarks of a great CFO-CEO relationship?
I mean, obviously, a huge part of that is trust, working well together. I think it's a big part of it's alignment. I think it's making sure that, we kind of believe in the same things. It's not like he brought me in just to control cost when he doesn't care about costs or anything like that. And then, I think a big part of it is, particularly with Henry and I, and this has been true of other founders, it's having someone that they can bounce ideas off of that has the perspective of, that sounds really interesting, but it's not going to move the needle. Like those sorts of things are really helpful. And frankly, I think part of my role is that Henry graduated from law school and founded his business in 2007. Like didn't necessarily see like history of someone who like went through the late 90s, the internet bubble, all the fallout from that kind of financial crisis, et cetera. So I think bringing kind of perspective and call it a third party hasn't been like in the weeds of the business forever, but has a view of the world that we can bounce off of the weeds of the business forever, like really, I think gives us a symbiotic relationship that we can help drive a lot of success with.
This may be a dumb question. Is it hard to tell a founder, CEO when an idea is a bad idea?
No. You might have to tell them a few times before it sinks in. But I guess that also kind of depends on the relationship. Like Henry told me when I first started, he's like, what I really like about you? It's like, you're not afraid to tell me when like something needs to change. Like that should be your role. And it's like big things or little things. Like literally it's like you're in a presentation and you're like, Henry, you should like change your tone a little. You should say something slightly differently. Like frankly, like there's 8 typos on this thing. Like we need to go fix it. Like all from the very little things to the very big things. Like having the kind of relationship where you can be honest and try to make things better is always the only way to work.
I like that you brought examples to it. So you have had a couple of times be like, I don't know if that's a great idea. Because I do think that CFOs, to a certain degree, you're kind of like on this risk frontier where founders are really hard charging and they have all these big, shiny ideas. I mean, that's what got them to this position. Then you have the board who wants you to manage to something that's probably a little more risk averse. And then you, the CFO, has to kind of rein in or broker between those two parties.
It shouldn't always be brokering. Sometimes it's like you should lean into that even more. Like those are, it needs to be really working on both sides. And I think there are areas where we're like, how many salespeople should we hire? And a lot of times I'm not necessarily the person that says, oh, well, we should only hire X number. Sometimes it's we need to lean into this in order to, make ourselves more successful or whatever else. And for, Henry, I think for a lot of like companies in general, like there's 50, 100, whatever things that you could potentially do in a particular time frame. And so, really looking for and focusing on like, here are the things you should lean into more and maybe do less of this other stuff is, just as important as maybe we need to be a little bit more conservative.
I never thought about it this way, but in many ways, the CFO is kind of the chief prioritizer of the company. You're making these resource allocation bets and trying to prioritize.
I certainly think of my job as being the chief investment officer. It's like, where are we going to invest? And whether that's time, money, people, whatever it is, like, where are we going to invest? And we need to have a process and thought process around what kind of return are we going to get from those different things? And at the end of the day, like everybody has finite resources, whether that's finite time, finite money, finite people. Like getting the most out of all of those things is the secret to success.
I do want to just flag that for listeners, those who are CFOs or aspiring to be CFOs. It's a pretty neat concept to think of yourself as the chief investment officer of the company. That is essentially what you're doing. You're investing the resources.
100%.
All right. What I'm going to do is take us into what we call our long ass lightning round. So the first question I've got for you, I ask everybody this one. What's an example of something you've screwed up on the job or in your career? It could be this role or any previous role in your life.
That's a great question. Probably it's like nuance of communication. And honestly, like this happens with the street fairly often is you kind of want to get the street to one place or another. And sometimes they underreact, sometimes they overreact. The same message just didn't come out the right way the first time. So like things like that are always good learning experiences and areas where, I always look to do better.
I love that example around communication, especially as a public market CFO. So thanks for sharing that. Next one I've got for you. If you could tell your younger self something, knowing what you know today, what would you tell him?
It's a good question. Embrace different types of opportunities. Don't just try to go in a straight line for what you're doing, because ultimately like those different experiences and those things that are slightly different actually add to your capabilities more so than like take you off course to wherever you're trying to go. So probably would have been, keep doing or maybe even do more of the, random things that interest you versus like what you think is going to lead to the next step in your life.
People do try to perfectly plan it out and it never really goes that way, especially finance people. All right, next one here. Hey, thanks for listening. We'll be right back after a word from our sponsors. Roll the theme music, producer Nancy. And with that, it's time to rep yo stack, sponsored by Tropic, the next-gen procurement platform helping modern CFOs take control of their budgets and bottom line. By combining approval workflows, supplier management, and pricing benchmarks all in one place, Tropic makes savings opportunities easy to find and act on. Visit tropicapp.io to learn how. Can you walk me through your finance software stack? What are the tools that you're using as a finance department to get the job done today?
Yeah, so we recently moved to SAP for kind of all the core like accounting and ERP functionality. Frankly, kind of removed a bunch of other things at the end of the day. We do use Adaptive on top of that for a lot of the kind of planning and reporting type things. There are a lot of pieces that kind of feed into that, whether that's like Coupa or we use like Thomson Reuters tax stuff on top of those. So yeah, those are kind of probably the biggest pieces, but like going to SAP, consolidated a bunch of other stuff that we had historically.
And what are you using for billing?
SAP.
Got it. What's the most recent tool you bought?
High Radius for like AR, like follow-up type stuff.
Nice. All right. Last question I got for you, Cameron. What's the craziest thing you've ever had someone try to expense?
So I used to work for a firm that serviced a lot of hedge funds. So there were a lot of financial services, like pre-SOX, like stuff that happened that, is less than savory that we had to go push back on people for.
Are you talking about late night bar tabs?
Late night bar tabs and other entertainment things in New York City can be an awkward conversation to have with someone.
Cool. Well, thank you so much for all the insights and for being generous with your time today. I had a blast, and this was super formative to me. So thanks, Cameron.
Yeah, thanks a lot, and have a good weekend.
Roll the credits, producer Nancy. The Run the Numbers podcast is part of the Turpentine network of podcasts. It is produced by Nancy Shue and edited by Justin Golden. Artwork made by Some AI Thing. Yelling and intro by Fat Joe. Don't forget to give us 5 stars. I really need this.